Welcome back to Finance News, the only show you need when the rest of the world is seemingly losing its mind. We've got all of the top goings on in the stock market, business and investing in the US, the UK and the rest of the world, so sit back, relax and let's get straight into your headlines. After the surprise invasion by Russia into Ukraine this week, markets around the world took a tumble, with some of the biggest losers coming from within the Kremlin itself. The Russian central bank has purchased millions of rubles to prevent the collapse of the Moscow Stock Exchange and prop up the currency after it plunged to an all-time low against the US dollar. Russia's main stock exchange fell 30%, falling from 3,000 to 2,000 points, while the MSCI index of shares in Russian companies traded in London and New York dropped by 45%. By midday, the stock market had reopened and the ruble recovered to trade at 84 to the dollar, although late in the day it climbed back to 87, and analysts said an escalation of the war could force the central bank to intervene further to prevent the currency sinking even lower. Equities also fell at the start of trading on Thursday this week through the markets in Asia, Europe, and then finally followed by major markets in the US, including widespread sell-offs across technology, industrials, and manufacturers. In the UK, companies like Rolls-Royce, Evraz and Polymetal were hit with double-digit losses, with Polymetal seeing more than a 50% wiped off its share price in a single day, although the price has since made some recoveries and now one of the biggest risers. Over in the US, markets had a rollercoaster opening day on Thursday as stocks were red across the board, but throughout the course of trading and into the close, prices made a significant comeback. Especially in technology, companies and big names like AMD, Nvidia and Tesla all opened into the red to form a late comeback as investors looked to grab stock market bargains and finally realised that short-term geopolitical events will probably have zero effect in the long term. In other short-term swings, oil continues its rally, hitting over $100 per barrel as the Russia-Ukraine conflict seeks to destabilise the supply of crucial energy products to Europe and the rest of the world. The prices of the black gold commodity rose to over $105 per barrel on Thursday, which is the first time that oil has risen to such prices since 2014. Russia is currently the single largest provider of natural gas to Europe, providing around 35% of its current supply. If you're enjoying your finance news so far, please drop me a like. It really helps out small channels like mine and gets the vital news service like this out to more people. Now, with that being said, let's get back to the news. In the crypto market, digital assets proved that they were not immune from current geopolitical events, with the price of Bitcoin falling on Thursday as Russia's invasion began. Bitcoin and other digital assets initially fell, but recovered over the past 48 hours, recovering much of the lost ground. As of the time of filming, Bitcoin's price sits at around $38,000 a coin, up 7% for the day after being beaten down to $35,000 earlier in the week. Across the wider market, results were similar, with the overall market being up 7.29%, bouncing back from lows of $1.5 trillion to a $1.7 trillion market cap for the entire sector. Ladies and gents, I think the kangaroo market is back. Everything's hopping all over the place. Penny stock season is back again. In news close to home, Ikea opens its first UK high street store, the famous Swedish-based furniture store where shoppers get lost whilst trying to buy some new pint glasses but end up with a toy snake, has opened a small inner city branch within an existing shopping mall in London. The branch is based inside a small shopping mall in Hammersmith and will let customers get smaller items whilst not stocking oversized flat pack furniture which would need to be ordered online. The holding company that owns and manages most IKEA stores said they are looking to invest over £1 billion in the UK market as they expand into inner city stores. Watch out, fast food and takeaways, they might be bringing the meatballs with them. So Martin Sorrell, the digital advertising boss, noted this week that he considered moving his currently UK listed business to the New York Stock Exchange. The former WPP executive who founded his current venture, S4 Capital, has said this week that he's disappointed by the performance of S4 Capital on the London markets and thinks they would probably get a better valuation in the US markets. Speaking to the press, he said that they had initially looked at the use of a SPAC but were put off through costs. But watch this space if anything ever was going to happen. The current share price of the company is around 480p, down from the highs of 870p from last year, which is nearly 50% down. Staying in the digital world, fashion retailers Boohoo and ASOS have been struggling recently with supply chain pressures and falling demand from consumers. With the high price of living rising and the inflationary pressures in shipping goods around the world, low-price fashion retailers have really struggled to keep up since their boom during the lockdowns of the pandemic. High amounts of short interest in the company remain, meaning that traders are still betting that there's money to fall from these former darlings of the UK market. Shares in Boohoo have fallen below 85p, which is their lowest level for more than 5.5 years. Its fiscal year ends in February, so watch this space for results in the coming week. Turns out fast fashion is a really fast way to lose your capital too. Back on the bricks and mortar high street, everyone's favourite boss Mike Ashley, the infamous retail billionaire, is looking to raise some capital with the sale of some of his business ventures. The retail tycoon has put his out-of-town retail property up for sale in a move that's likely to raise more than £300 million. Ashley, who currently owns Sports Direct, House of Fraser and Flannels, is looking to take advantage of the recently renewed demand for out-of-town retail parks which have seen themselves take shape as a click and collect hub and better investments than traditional high street shops. 16 assets are being sold in total all over the country. Rumour has it that with the newly found money, he's going to buy the dip and go all in on Palantir and Tattooed Chef, or that might have been completely made up. Never trust random people on YouTube. With the headlines out the way, let's talk about everything in the IPO market and see what's been happening in IPO of the week. Ooh, IPOs of the week. I wouldn't be doing that in public. According to Reuters, Porsche, or however you want to say the name of the popular sports car company, is looking to IPO in Q4 this year. The company, who I reported on last week, with many stranded new vehicles aboard a container ship that had caught fire, is in advanced talks about getting their name on the public markets. The company is currently owned by the Volkswagen Audi Group, and the parent company is looking to take advantage of the hot IPO market, with estimations that this valuation could be worth anything up to £75 billion. However, nothing is finalised, and the management team at the group will need to approve anything before the brand goes its own way. The group is currently looking to accelerate its growth into the valuable EV space, which has been dominated by the likes of Tesla and other recent players like Rivian and Lucid. Although if Porsche does IPO, at least they would produce cars and be profitable. But that does seem to be coming back into fashion at the moment with investors. Exciting times. And with everything else going on, let's see who else is not having such a good time at the moment. Just when you think it couldn't get any worse, fails of the week. Popular US stock trading app Robinhood, made famous during the bull run on meme stocks like AMC and GameStop, has seen its share price drop even lower over recent times. The publicly traded company released its earnings this week for Q4 and shared some Q1 guidance, and the results were not as expected from street estimates. Equities revenue has tumbled 35% year over year, monthly active users has dropped 8.5%, and even the crypto trading side of the business has seen a 5% decline versus the quarter before. Average earnings per user also declined by 39% to $64 on an annual basis, showing that free trading has definitely got some ways to go to really start turning on the cash generation. Since going public, the stock had initially been pumped to the moon, as traders like to say, but since its highs in August of over $70, the price has come right back down to earth, losing 83% of its value. The share price now sits at around $11.50 at time of filming. Might be a time to buy the dip now, unless the dip keeps dipping, then you're really screwed. Who knows? After all that excitement, let's now come to everyone's favourite section, where I handpick the best posts from Reddit's Wallstreetbets. Let's dive straight in. Welcome to the best of the bets. First up, this Redditor has clearly been looking at too much historical analysis that shows how certain sectors benefit from international conflict. For every growth stock with no profit that gets hurt, someone else gets the benefit. When looking for new investments during volatile times in the market, this post shows you the kind of things you need to look for in a top management team. You need people who can sell the dream, woo investors by any means possible, get their money, and clean it up through the crypto market, and then finally take that money and use it in the worst global music festival you've ever seen organised in your entire life. Sounds good. If you've just bought the dip, but the dip keeps dipping, and you've already remortgaged your house and took out more margin to buy unprofitable growth stocks because someone told you on YouTube, then you're going to need more skills than this bird to prevent your wife from seeing your joint trading account. And finally, if I don't remind you enough not to take investment advice from idiots on the internet, then maybe this visual cue will kick your ape brains into submission. Can confirm being kicked there really does hurt. Anyway, with that said, please drop me a like if you've enjoyed the video, subscribe for many more, and I'll see you at the same time next week for finance news. In the meantime, stay safe and hodl. Happy investing.